Thank you very much for joining the masterclass on business valuation. Today we're gonna have fun, I hope. We're gonna be talking about business valuations, different ways of making a valuation, not the most traditional one, which is EBITDA. Of course, we are gonna go in depth with talking about EBITDA multiples, how to make a valuation using the EBITDA indicator. And today we are gonna have a special guest, a very good friend, Roxxane Reid. She's a valuation expert. So she's gonna be joining me on this presentation. She's the co-host. So soon she's gonna be explaining the different ways you can do a business valuation, different ways you can find hidden liabilities. And yeah, she's the best I found online. She's the best business valuator. I really trust her. So I hope she's gonna make a great presentation. She's gonna do a great for this masterclass. So I feel great about having her here. So yeah, thank you very much, Roxxane, for participating on this. And then I will allow you to give your presentation soon. I just got a couple of slides on my computer so I can show people what I think about business valuation and how I do in the evaluation myself for all the companies that I've been analyzing for the last 12 years, right? So let me share the screen here just now. Yeah, Google Chrome, yeah, this one. So here we go with the slides. So yeah, the presentation of today is all about how to create an exit plan for your business, how to do a valuation, right? So why you need a valuation? You need a valuation for mainly two things. One, for knowing how much your business is worth, so you are ready for exit. And another important thing is when you buy in a business. When you buy a business, you need a valuation. When you sell a company, you also need a valuation. So it's all about, today I'm gonna speak about how to create an exit plan for your business, right? And also we are gonna discuss different ways of making a valuation. So here you have an introduction. So planning for the sale of a small business may be seen daunting, right? Perhaps you are not sure where to begin or how to go about selling your company or buying a company. Right? To make the process as easy as profitable as possible, you will want to start planning early. And one thing of planning is making a valuation, right? If you don't have a valuation done, you are not ready for an exit, right? Because you need to make it easier for the buyer, right? It's all about making your company, organizing all the information, all the data room, so the buyers, when they sign NDA, they start gathering their financials, they can see an organized company. They can see a tidy company. And that makes the company valuation increase, right? So five ways to sell your business, you know, is defining an exit strategy. You need to have your team of advisors. You need to have a building the data room. For when you sell in your company, when you're making an evaluation, it's important to have a data room, right? A data room ready. I will explain you what it should be included into your data room. Also, you need to know how much your business is worth. For that, we are gonna be chatting today about all different ways you have to make a company valuation, right? I will explain 4 ways, but I'm sure Roxxane has so many ways and she will explain using her own slides, right? That she's been presenting for, organizing for today. So another steps to sell your company will be what you do with the money from the sale of your business. So most people, they don't know what to do after you sell your company. So for that, I would recommend to have a tax plan and to explain you what is better, an asset purchase or a stock purchase, or what to do with the money, where to put the money after you sell the company, right? For tax purpose. So exit strategy, the thing that we are gonna be also discussing today. So every entrepreneur, every business owner must have an exit strategy. I know most of us as a business owners, we are good at building businesses, but sometimes we don't think about how to exit. So having an exit plan is very important, an exit strategy, and developing it from the initial business activities, right? No just last minute, you know, valuation, last minute exit strategy. You need to be prepared. Also, you need to know who can be my potential buyer, who can acquire my company. Should I go public or should I sell privately to a family office, private equity firm, or should I go public and do an SPAC or do an IPO, right? and also which stock exchange is more convenient in my own country, or I can do double listing. So you need to have an idea what to do with your company. After you build a great business, the big paycheck that you're gonna get is when you sell your company. So making a valuation is a very good, important thing that you should consider, and also preparing your company for sale. It can take 6 months, 2 months, it depends on the company size, but I recommend to start preparing your company from the beginning. Also, once you start a company, you're thinking in terms of how am I gonna exit this, right? So always think about exit strategy, valuations, right? Having a proper team of advisors on board, it would help you also, right? To buy companies or to sell companies. In this case, we are talking about exit companies, making valuations. So teams of advisors, which kind of advisors you will need, right? In terms of exit your company. I always recommend to having an M&A lawyer or transaction attorney, they call it in the US, for all the regular documents that you're gonna be signing, right? With buyers and sellers, like NDAs, non-disclosure agreement, letter of intent, share purchase agreement, stock purchase agreement. All these clauses for the legal due diligence, you will need an M&A and transaction attorney, right? Also, you will need a CPA for preparing all the tax returns, profit and loss, balance sheets, and for accounting due diligence, right? So these two things, these two people is very important for adding them, right? So let's admit more people so they are not left behind. So M&A advisor, also it's good to have an M&A advisor on your team for helping you, connecting you with buyer, with seller, checking out all the information, all the data room, helping you with this. And then a very important person also is a tax planning expert, right? When you sell in your company, having a tax expert is very important, because you need to know, if it's better to do an asset or stock purchase. If every state have different tax implication, also it's good to understand about the tax implication, asset protection, right? And another very important people that you need in your team of advisor is a valuation expert. This reason we have today Roxxane and Reid to explain about different ways of valuation, and she will explain you with her own slides, right? So yeah, let's continue. This team as advisor, but a very good and important one. This reason I wanted to make this masterclass today about valuations, fully focused on valuation, because if you don't have a valuation done, you don't know how much your business is worth, and also the buyers will realize you are not ready for an exit, right? If you don't have a valuation in place. So this was a team of advisors. In terms of building the data room, right? So in my own case, when I'm preparing a company for sale, or when I am analyzing a company that I want to buy, I always request a data room, a virtual data room. Right? So they share me a Google Drive or any softwares, right? Virtual data room softwares, with all these descriptions, right? So below is a simplified checklist that will help you to create a data room with ease. For example, I always request the marketing materials, financial and tax information, legal documents, human resources information, private and confidential data, inventory assets, right? Asset inventory is very important, because my methodology to purchase companies is doing leverage buyout, right? So for me, it's very important to have all the asset inventory, so I can see how can I use those assets to raise capital using the alternative finance market, right? Which is asset-based lender, cash flow lender, revenue lender, right? So for me, asset inventory as a buyer is really, really important, right? Also, we need to get the evaluation of the appraisal of the real estate, the evaluation of the company. So the assets for me are very important. Also, general contracts that the company target have, customer and vendor list to understand, which are my main clients, and other items. So having in place a virtual data room, I always say is really, really important. Either way, you buy in a company, you want to get a tidy, a very organized data room. And also when you sell in a company, you want to have a proper data room, so the buyer will see, okay, this company seems very organized. They know they are fully ready for an exit. If a company that is for sale, let's say you go to visitforsale.com, bizbuysell.com, all those websites, or Flippa, or you can go to microacquire.com, and they don't have a virtual data room, for me, that is a red flag as a buyer. I can detect that they are not ready for an exit. Right? So if they don't have a virtual data room, they are not ready for an exit, and then maybe I'm not going to be interested to proceed with the business buying procedure, right? So this was the building the data room, right? So what is your business worth? So now we are entering into the valuation side, right? So what is the list here? What do you okay, here we go. So what is your business worth, right? For me, it's very important to quickly analyze deals. I could spend hours and weeks analyzing a deal, making a valuation, but then I would prefer to delegate that task to a valuation expert like Roxxane, who is here with us today. But how can I do it myself quickly, right? So I would suggest making a company evaluation with a valuation expert like Roxxane. But what I do normally for applying this, I apply these 4 valuation formulas, right? Earnings multiple, do a discounted cash flow analysis, revenues multiple, and EBITDA multiple. Guess which one is my favorite? EBITDA multiple, correct. Yeah, very easy for me, right? So those four ways of making evaluations are the easiest way and the most common ones, right? I don't want to go in depth with the EBITDA multiple, with revenue multiples, because each industry, they got different multiples, right? It's not the same making a valuation for a healthcare company or a trucking company. Earnings multiple, the same. It's not the same making a valuation using earnings multiple for a trucking company, for a manufacturing, or for IT or cybersecurity company. And discounted cash flow analysis, this can be applied for most of the industries and sectors, right? In terms of EBITDA multiple, why is my favorite one, right? Because as a buyer, it's not convenient maybe for us sellers, right? But as a buyer, what I do, I buy companies 3 times and 4 times multiple EBITDA, because that means in 3 or 4 years, I will recover the money. And also I realized that most of the lenders, most of the investors in the US, UK, Australia, and Canada, they will like to invest, or they will like to lend to cheap deals. Cheap deals mean 3 times, 4 times EBITDA maximum. Sometimes you can buy for 2 times EBITDA, some e-commerce company, but it's very difficult and rare to find them online. So EBITDA means the free money I have to spend for the debt repayment plan, and also to pay to my investors and to pay myself dividends, right? So for me, the EBITDA number is the number I check out on the balance sheet to see how much money I have free to spend on debt repayment, right? Interest rate, investor dividend, and also my own dividends, right? So if the deal is now making me 200,000 net per year without me being involved, I don't get into analyzing this deal and spending more time on this, right? Because it's not worth my time. So if I want to get 200,000 out of a deal net without me being involved, what I do is I put a solid management in place. So I will need to have a big EBITDA to take money out to pay a proper CEO. I will need to have a big EBITDA to pay the debt repayment plan if I take in a loan. Also, if I bring an investor on board with me to co-invest, I will need to pay them dividends per year. And then I will collect 200K for me as a dividend, right? So I will need an EBITDA of 800,000 approximately, with an asking price of 2.4 million. This is my way of buying businesses. This is my way of analyzing companies, and why EBITDA for me is the best way to analyze it, because I can see the money that I have free to spend, before interest, taxes, depreciation, and appreciation, right? So this is was a little bit of my own presentation, and then I want to show you also. I share with you the masterclass documents, right? I share with you this masterclass 2002 documents, and I want to quickly explain you what it's all about and how you can use it, right? Because you got this link also, and then I share with you here. You have the NDA template that you can use it and rebrand it. You have a letter of intent template to send offers, right? and the NDA to share with the buyer or seller to disclosure information. Then you have a memorandum of understanding templates that you could use, right, for doing roll-ups mainly. I use the memorandum of understanding to everybody be on the same page. So everybody's on the same page with the memorandum of understanding. Then you have an introduction fee agreement that you could use for getting a fee when you introduce somebody a deal. They can pay you an introduction fee. Then question to the seller form is very useful when you do a physical viewing of a company, and all those questions you could ask to the seller, right? So it's very important when you're doing a physical viewing. Then I have a good Rolodex of lenders, brokers, financials in UK, US, Australia, and Canada. UK bank directory that you could use as a deal maker, a global family office database that also is very helpful to find co-investors, co-partners. Right? I have a private equity firms in New York database, private equity firms in Texas and California. I have a very good negotiation preparation checklist that I took from Harvard, right, to Massachusetts. When I went there to study negotiation, I took this negotiation preparation checklist and I adapted to M&A space. Right? Then you have a due diligence checklist to do a preliminary due diligence without getting involved to a CPA, accountant, and a transaction attorney. So you can do a preliminary due diligence yourself, and then you, of course, need to hire a valuation expert. You need to hire a CPA accountant and also a transaction attorney for the legal and accounting due diligence, and making sure you buy the right deal or you sell the right company. Then you have a simple company pitch deck here that you can use for preparing your pitch deck presentation. Then you have an M&A pipeline Excel to put all the deals that you are analyzing here. Then you have a teaser, which is a one-page presentation. Normally brokers will send you a teaser or one-pager is called. It's just a summary of the company that you are analyzing, right? That you are trying to buy or you're trying to sell. Then you have a wealth database. There's a few investors there, a few people interesting that you can co-invest or co-partner. Then you have a business valuation calculator that also is important, that you can do it yourself trying, but it's not easy, right? This reason we always need a valuation expert to help us with the valuation. Then you have a deal analyzer to quickly analyze deal. It's a good spreadsheet that you can take it right for you and play with the numbers, input in numbers. Then you have an investor letter templates to contact investor. The best way to reach out to investor, you can use this investor letter to invite them to invest into your own deals. Then you have an M&A data room checklist, to check out all the data room that we were discussing, how to prepare your own data room. Here is a Google Slides. How is the process of buying a business that you can get it now. And then I bought all the data from all the brokerage firms and M&A boutique in the US, UK, Australia, and Canada. Here you can find 1,000 online places to find deals, right? I have 700 plus emails from brokers there, so you can use this very good resource. Then you have our deal-making brochure if you want to join our 12-month deal-making program, right? And here you have a 1 month free subscription for the M&A newsletter. So you get 1 month free of the subscription of our National Acquisition newsletter, which is growing very rapidly just now. And here we're building an M&A dictionary for you, coming soon. So watch for this spreadsheet, because we are updating all the time. We're adding content, we're adding more tools, so you became every day a better deal maker, a qualified buyer, which I call it, right? So I think that is enough of me. I think we could go back to what is called to chat with our valuation expert, right? So I think I will do the introduction to the special introduction to my very good friend Reid, right? So here we go. So I want to put you on what is the participant? Here we go, capital. Okay, now you can activate your audio. Roxxane, yeah, Roxxane. Solicitar, yeah. So here we go. Can you, yeah. Okay, Roxxane. Thank you very much for joining us. I'm very excited to have you here. It's awesome that you could explain all what you know about valuation. So please let me introduce you to people who join us here today. I think you could easily share your screen, right? You can easily share your screen and then explain. I will explain all what you know about this exciting topic, right? Valuations. Yeah. So, yeah, you can introduce yourself, Roxxane. Yeah.
Thank you, Sebastian. First of all, I will let everyone know that I'm recovering from laryngitis. So I apologize up front if my voice isn't as clear. So what I attempted to do was to put a lot of details into my screens, which I may not read them all verbatim, but they'll be on the screen for you to see. And I do thank everyone for coming today, and I especially thank Sebastian for holding this event and hosting this event. And the document list that you just shared, Sebastian, I've never seen such a detailed list before. So that's definitely absolutely priceless. So without taking a whole lot more time, I'm going to start right into on how to evaluate a company, just so that I have a chance to maybe save my voice. So as Sebastian shared a little bit, yeah. I am a certified Main Street broker. I'm also a certified exit planning advisor. And with that, I belong to a number of associations, including the International Business Brokers, Mergers and Acquisitions, International Society of Business Appraisers. And I'm currently enrolled in the Columbia School of Business, taking mergers and acquisitions. Always updating.
Awesome.
Why do you do evaluation? Well, you want to assess the opportunity, and you also want to assess the cost of that opportunity. Sometimes it's not apparent without having an evaluation done. One of the things I wanted to point out that why the business is being evaluated will affect the type of valuation method used. Sebastian mentioned that he loves EBITDA. Well, EBITDA is a measure of the earnings. So if you're in a startup and there are no earnings, well, then you're not going to be using EBITDA or EBITDA as your valuation method. You're going to have to use another type of valuation method. The other thing I wanted to point out is that the size of the business will affect the level of credentials that's needed. We're working with the Main Street businesses, often non-certified valuations called brokers' values of opinion, brokers' opinion of values, are just fine. And they're useful for SPA loans, or I'm here in Canada, and I know that my top lending institutions love my brokers' values opinions. And those are things that can be done for, maybe just a couple of $1,000. But once you move into your M&A deals, they're often going to require somebody who is certified, somebody has an appraisal or evaluation, and really large M&A deals, like we're talking public companies and things that are multi-billion-dollar companies, they're going to actually require a certain type of accountant that has the special designations specifically for valuations. So Sebastian has provided a document where you can go in and do some quick valuations. I've also added into the chat room a really great source for spreadsheets and Excel sheets is the corporate financial institution.com. So I provided that in the chat room. So take a look at what they are offering for free services, free documents, and just a wealth of resources and free information. I'm talking hundreds and hundreds of documents and spreadsheets for your use. Because once you understand the importance of evaluations, you'll be better prepared to identify opportunities, good from bad, good to great, and great to outstanding. Because why should you settle for a good deal when you could have an outstanding deal? And that's what we want to have. We don't want to waste our time. And sometimes it's hard to know when you're comparing companies, what is going to make the best deal and what's going to really jump off the page for you. So when I start my valuations, and one of the key programs, and I have several different programs that I use depending on the level and the need of the valuation. But I start with a qualitative assessment. We look at general information, including the company size, the positioning of the company, as a whole. We look at the market, size, growth, share, what there is for competition, exposure to business cycles, exposure to legal factors. Then we look at the management. Management plays a key role, and I'll touch base on this a little bit later as well, but the management quality and the reliance on key persons. We continue into the sales, reliance on key customers, reliance on distribution partners, customer lock-in, purchasing, going through product, having something worth selling and having something that customers want to buy. That's why you have a company. So what about the product, the quality of the product, the innovativeness of that product, the intellectual property that goes with that, and what type of risk is there to technological distributions on that? Then we do look at the financials, of course, how capital intensive they are, whether they're leveraged. Sebastian mentioned that he likes doing leveraged buyouts. And then you look at the foreign exchange currency risk. So the qualitative assessment that I do and the program that I prefer has these items all based on a scale of 1 to 5. And based on where the values are input, then we determine from that, because it's all in the computer, we look at the risk factor, the cost of the equity premium, and the discount to trading multiples. These are all key factors that are going to affect the valuation of that business. So factors that increase the valuation multiple, these are things you want to know. Recurring revenue, look for it. Loyal customers, long-term contracts, renewable subscriptions, a strong management team, energized workforce, owner not working in the business. I cannot stress this enough. If all of the knowledge and all of the expertise and all of the skill in that business is sitting on one person's shoulders and in one person's head, something happens, you got a problem. So you need to have a strong management team. That's what you're looking for. We're looking for growth. We're looking for scalability. We're looking for a demonstrated historical growth as well. Either it's stable or it's increasing. Factors that decrease the valuation multiple. Reliance on key customers. I've actually seen companies that had one customer, which is great, until that customer is not there any longer. Then where does that leave that company? And especially if that relationship with that one customer sits on the goodwill of the owner. Maybe they went to school together, maybe they grew up together, they have a long-term relationship. So you get a new company, and now what happens to that one customer? Maybe he likes you, maybe he doesn't. That's a big risk. So again, going back to owner dependence, their skills, their abilities, their personal contacts, because personal goodwill is not transferable. There's no guarantee that the new customers, the customers, are going to like you if they did the original owner. So you need more than that for the company. And then volatility in earnings. If the earnings for that company are all over the place, you need to have a hard look at your skills in turning that around. So some common valuation methods that we look at is the, I'm going to reduce something here on my screen here, the multiples approach, so also known as comps, where you multiply the earnings of a company by the price earning ratio of the industry. Smaller businesses are typically multiplied by the seller's discretionary earning, also known as adjusted net or discretionary earnings or the owner benefit. Larger companies over $1 million are typically shown as multiples of EBITDA. Another common valuation method is a transaction approach, and these are also known as precedents. And this is where you're comparing the company that you're buying to recently sold or acquired companies in a specific industry. So if you're buying a manufacturing company, we're going to go and look for other manufacturing companies that have sold. And yes, that information, even in private deals, are available, and definitely available in publicly traded companies. In the program that I use, I can actually tell you who's been buying in the last whatever time frame I choose. So, who's been buying in a space for the last 3 months, 6 months, 18 months, 2 years, whatever, again, whatever time frame I want to choose. So I can actually, if a company wants to come to me and say, I'm thinking of selling, then I can help them find a buyer, because I have access to that information, who's buying. And that's a good starting point, is to know, and what they've been paying. And my information even goes so far to tell me as to how the deals were structured on the previous companies that were recently bought and sold. So another common valuation method is a discounted cash flow. This is discounting the future of a value of a cash flow back to today's value. It's also known in financial industry as time value of money. So what would you pay today for a series of $200 cash flows that were being paid in perpetuity? And the cost of capital is 10%. Well, the value is cash flow divided by the weighted adjusted capital cost. So $200 divided by 10% is $2,000. So you would pay $2,000 today in order to have $200 paid to you forever. Those things I always find interesting, and I happen to love. This is where my geek comes out, my inner geek comes out, when we start talking about compound interest and value of money. So going back to the enterprise value and EBITDA ratio is used to compare the entire value of a business with the amount of EBITDA it earns on an annual basis. Enterprise value is the market cap plus the market value of debt minus all cash and cash equivalents. So it's widely used because it provides a clear picture and shows the potential growth opportunities for the company that you're reviewing. It determines the multiple that is going to be used. So every industry has a multiple that is assigned to it. And this goes even to your banks. When you go to borrow money, there are codes that are used in the industry, NCIS, NCAISS, and these codes have to do with how the bank and how lending companies actually view the lending risk for that company. So all restaurants have an NCAS code, all again, manufacturing companies have an NCAS code, and going with that, they have multiples with that. So it's also useful for comparing the valuation of multiple companies. So if you're looking at buying several different ones and you're saying, what one, what company is going to give me the best multiple. So again, if you're comparing it to a restaurant, comparing it to an electronic company or an IT company, knowing what's going to give you the most bang for your buck, it might help you decide, which direction that you're going to take to put your investment in, your money in. It's also used to calculate the terminal value in a discounted cash flow. It's used for negotiations. So when you're going to acquire a business, knowing that that particular industry has a multiple of 4, and when you get to see their financials, and let's say that they are asking, $2 million, what's it based on? Because if it's based on the EBITDA and their industry is only a 2 times, then you're thinking, okay, where do the 4 times come in? And we will touch base on this on another screen a little later, because there are times and places where when you're best of class, it will drive up the multiple that is being applied to the company. And again, you're going to want to know that, why is this person asking for a 4, 5, 10 times multiple when the industry average is 2.5 or 3 or 4? So in calculating the target price for a company, So let's say you're thinking of going out and buying a company, and if you know what the multiple is again, then you're going to know what to be offering for that company, because a lot of the times you're going to be working with those owners long term, and especially as that transition period. And the worst thing you ever want to do is go in and insult them. And I've seen it happen where they tried to make it happen, where they're coming in and they're offering half the price. Well, if that's what you can afford, that doesn't make it that's what they're going to sell it for. Because when a seller knows the value of their company and know that it's been evaluated property, they have absolutely no reason to give it to you for half price. And they simply won't. EBITDA pros include easy to calculate. Information is widely available. It's referenced in the financial community, so most people understand it. It works well for evaluating stable, mature businesses with low capital expenditures. So as I said earlier, you would not use EBITDA to value a startup company, because a startup company doesn't have the earnings. And that's what EBITDA is for, is earnings before interest, taxes, depreciation, and amortization. So if there's no earnings, you're not going to use EBITDA as your valuation method. So it's good for comparing relative values of different businesses. Cons, not a good proxy for cash flow. Some people want to use EBITDA as a replacement for cash flow. It really is a different calculation if you're going to get technical. So if you want to do it that way, it's just good for you to know that it may not give you the best cash flow concept that is relative to what you're doing. It doesn't take into account capital expenditures. So when you're buying a business, you need to know, how old that equipment is. And I had a little convenience store that closed just a few weeks ago, and the owner wanted, $120,000 for the equipment. Well, we had a evaluator come in specifically for that equipment, and it came in at $58,000. So in good conscience, I can't recommend that my buyer puts themselves at a disadvantage to buy old equipment, because is it going to break today, tomorrow, or 3 years from now? We don't know. EBITDA is hard to adjust for different growth rates, and that I've got a really interesting one on that, and I'll come back to it. Hard to justify observed premiums and discounts, because those things are very. I'll just bring my screen up here a little bit. Those are really subjective. And that's where the art comes in when you're doing valuations versus the science. Knowing what discounts were applied, even what premiums were given. That's where it comes down to the person doing the valuation. And it's important that they have a really good conversation with the seller or in the buyer, if that's the case, to get those numbers, because it can tweak and it can adjust slightly. Hard to adjust for different growth rates. I did a valuation about 3 weeks ago, and I had never seen anything like it. This particular business, the EBITDA for 2021 was 102%. And typically an EBITDA of 10% is good. And your Standard & Poor's, your stock market has companies on there in the 11 to 14% range. Because think about it, if you're going to invest in a company and you can get a 10% return, you're happy with that. If you can get a 15% return, even better. But this company was showing 102% EBITDA. I had never seen it before. So then the question is, what's causing that? Is that sustainable? What's happening in that industry? So when I went out and did the comparables to the peer group, I actually found several other companies worldwide. One of them was in Sweden, and their EBITDA was 52%. So, you know, that is then the big question with the broker that I was working with in the US was, oh my goodness, where do we price this? You know, where does this really settle? Because it's a challenge to, without having a history, to know if this is going to continue. So the solution around things like that are then to look at other ways of buying the business and other ways of compensating the seller, you know, offering an earn out perhaps would take care of that. So I want to thank you for your time. If you need further information or would like to know a little bit more about it, you can find me here at 506-238-0133 or at info@capital-valuations.com. So that is my portion on that, Sebastian. I do have a little bit more, if you recall, and I'm trying to find my stop share here on a slide deck that I had sent you previously, because there was a few things that I did want to touch base with on that slide deck as well, if we have time.
Yes. If you have time, you can explain just somebody asked, can you explain the difference between seller discretionary earnings and EBITDA? And with that, we can finish it today.
Okay. So your seller's discretionary earnings, that really is the true money that's left over. At the end of the day, when evaluation is done, you know, what can you actually, you know, see in your pocket? When we're doing valuations, we do allow for one owner's income, and we want that to be a market income. So if, for example, you're looking at a company and the owner has been paying themselves $500,000 a year, you know, and it's really just sucked all of the value out of the business, you know, we're going to adjust for that. It's called recasting, it's called normalization, a couple different terms people use. And conversely, if we have somebody who has not been paying themselves, like say they've been paying themselves $50,000 when the industry average would be, you know, maybe $90,000 or $120,000, we're going to adjust for that. So all of those things take place, and that's where it gets interesting. So those adjustments are between the EBITDA and the discretionary earnings. So that's the difference between the two, is what's been adjusted out. EBITDA is going to show it as all in there. Discretionary earnings are going to take out any one-time big expenses. You know, my goodness, I had one here last fall, and the seller had a $10 million business. They had everything in there, including the kitchen sink. You know, they had $56,000 of personal insurances. They had a cottage in there. They were paying taxes for everybody that was in their family, their property taxes. You know, it literally took me weeks to clean up those financials. And I quite frankly didn't make a dime on that valuation when you think about my time. And, you know, in the end, it still wasn't perfect. So that's one of the key differences between EBITDA and seller's discretionary earnings.
Awesome, Roxxane, thank you very much. Yeah, I know you're suffering with your voice. I really appreciate you could join today and give this amazing masterclass about valuation. I highly recommend to any of you who is watching this masterclass. We will be sending the recording today or next week. But yeah, if you need to make a valuation, my trusted valuation expert is Roxxane. This reason I wanted to invite her. So if you need any of this kind of valuation service, I will recommend to hire her. So thank you very much, Roxxane. And then, yeah, we are going to be publishing this into our network. So thank you very much, everyone, for joining this masterclass on business valuation. I hope you enjoyed. If you have any questions, just send me by email or send to Roxxane. She will happily answer any of the questions. Again, thank you very much, and see you in the next masterclass. We don't have a topic for the next masterclass, but yeah, see you in the next one. Thank you.